Welcome back, everybody. It's Katie and
Matt and
Ryan.
hey, team. How's it going?
it's going great. How are you?
I'm doing all right. Pardon my little scratchy voice. I'm kind of just getting over a thing. I think we can all relate. I've heard there's something going around out there, but then again, there's always something going around, especially when you have a 10-year-old at home, little germ carrier.
Yeah. Yes.
Thanks for pushing
So
through
my-
and still meeting us, Katie. Appreciate that.
Yeah.
Thank you. Thank you. No, absolutely glad to be here. Always excited to talk with you guys. So let's hop right into it, Ryan. Tell us a little bit about what's been going on this last month with rates and apps and all that is mortgage.
Yeah, gosh, as we approach the halfway point of the year, the big story with interest rates so far is how stagnant they have been after so many predictions had us really at lower rates at this point. So, there's a few reasons that we haven't seen this significant drop. And one of it is increasing in costs, and this is mostly shelter costs. Insurance is one that we've probably all seen and noticed is higher now. Medical, energy and gas, and a lot of people are feeling, of course, consumer goods like groceries. We're all seeing those higher grocery bills still, so we're not really seeing these drops in prices that we're hoping. And on top of that, the Federal Reserve, they're hoping year over year seeing much more of a drop in inflation. We're at 3.36 right now, and they want to get us around 2%. So we're not there yet. We're not where they want to be. And another big reason for that is consumer spending. It's still high right now. Even though costs are high and there's a lack of available credit, we're still seeing spending at high levels. And also the job market so far year to date has been pretty resilient. We're always getting these strong jobs reports, even though we're hearing more and more, layoffs happening out there. But it's been an interesting week. We're finally seeing a good drop in rates this week, about a quarter just over the past 3 days.
Nice.
And a big part of this was because we're seeing weakness in the jobs market. The ADP employment report just came out, and it came in much lower than expected, about 23,000 jobs. And we're starting to see signs that consumer spending is losing steam. Now that this sounds like a bad thing, but when costs are going down and when consumers stop spending, this is kind of what the Fed wants to see. This is going to help us drop to that inflation figure of 2%. So when you're kind of seeing that in the news about weakening in jobs and consumer spending, that may trigger the Fed to start dropping rates, and we're going to really start seeing interest rates drop from then on. So it's something to keep a look at, but it's been an important week that we're finally starting to see this weakness in the jobs market and with spending as well.
Awesome. Yeah, I know that we have a bunch of buyers still, even though we're suggesting rate buy downs and giving them some different advice. We still do have some buyers that are sitting the fence that are waiting for these rates to come down before they jump on something. Are you experiencing the same thing?
We are, yeah. We've seen a lot of people who were on the fence were expecting to see the lower rates, and they're kind of still staying there because conventional rates as of today are still in the low sevens, but you can start still getting government rates in the low sixes. But I think once we start seeing the conventional rates get to this below 7% range again, is when we're going to start seeing some people come off the fence. But we have noticed that as well.
100%, that seems to be the threshold, right? And when we're under that, then we see more activity. And this has been true for the last, however long, many months, a year even, that we have been seeing that 7%. Once we're over it, things kind of back off a bit. And then once we fall just below that on your conventional rate, we're seeing a little bit more activity. So it's still the same. So it's very rate driven still.
Yes.
How about applications?
Absolutely.
Applications, though, we've definitely it seemed like it was stagnant for a little bit as well from what we're seeing, and a lot of that has to do with just the time of the year. Obviously, school's out. We see a lot of families going on vacation, getting out of the heat. So it seems like this is always a time where there's a little bit of a quiet before the storm of the second half of the year. So it is usually, it's kind of interesting. We've been doing this for over 15 years now, and you can just kind of see the trends and how it always plays out depending on the seasonality of everything. And we have really noticed just, right after school gets out that things do slow down for a little bit. Are you guys kind of noticing that as well?
Yeah, we're feeling that as well. And even in our conversations that we're having with families, they're saying, well, we're going to wait until fall and, get through the summer. Kids are off school. We need to go on this, that, and the other vacation, And so their focus is there. What are you seeing, Matt?
Well, and I think that's it. I think there's really no sense of urgency. So when there's no sense of urgency for people to, hey, we have to buy now, maybe because there's not a lot of inventory or we need to capitalize on rates, it kind of just makes it that much easier to kind of put it on the side and say, you know what, let's just focus on these other things, which is, I think, is kind of ultimately just building up that pent up demand that will pop. And it's probably exactly what's going to happen once we see rates drop, once we get through the summer, once we get closer to this election to see what's going on and people can kind of grapple with what the reality of America is going to be. And I think that's going to be one of the biggest factors. The thing that we've seen consistent throughout this is, you're seeing, luxuries on fire. It's still selling very, very quickly. People are not batting an eye at homes over $1 million if they are priced right and they're in that location they want. Still a lot of cash buyers in the market and a lot of finance buyers, and they're not really even pumping the brakes based on these rates. The thing that we're really seeing is going to be that the entry level home, the smaller homes, the homes that are going to be like under 1,500 square feet, those ones you really haven't seen the relief when it comes to like even a cost per square foot advantage. If you're going to be jumping in as a first time home buyer looking for that 1,300 to 1,500 square foot home, and you're using a 3% down payment type of program with FHA and stuff, you're still looking at a giant mortgage. And so you've got that inventory that's sitting because people aren't really motivated that quickly to jump off of that. And secondly, that's always been kind of an area of focus for investors, first-time investors, anyone that was kind of looking for, someone to put into their rental portfolio. But that's kind of also been a little bit of a hiccup because rates aren't there. So you either have to be an investor that's going to look at it and say, hey, is my cash on cash return going to make sense jumping into this pool? And it's really not, because you start to look at what rents are supportive in that under 1,500 square foot range. In Arizona, it used to be great. You used to be able to, you wouldn't compete with apartments when you were single family because apartments and such usually really only went up to around 700 square foot, 800 maybe for a 2-bedroom. But now we've seen just a lot of apartments come in with the build to rent. And then even stepping up with these apartment complexes that are giving you those 1,400 square foot, 3-bedroom, 4-bedroom options. So they're like, it's soft. I'm not going to pick this up and know that my vacancy rate's going to be super low because you're now competing with the convenience of this type of product. So I think that's why we're seeing a lot of this just sit. And then it's that kind of that weird range between like 650 to like the 750 range, 850 range, where people are like, we want to upgrade, we want to get a little bit bigger of a home, but we've got such a great rate. And, we're kind of settling on what we got to choose from. So
I have had the conversation. Sorry to interrupt you, but I have to tell you this because it's hilarious. I have had the conversation with a few sellers over the last couple of weeks, and they all have said the same thing. I really want to sell my house because I don't want to live here anymore for XYZ reason, but I'm in love with my rate. I think I like my rate more than I like my house.
It's true. It's true.
Yeah, their house lock is what they call that. And that's huge. And again, you said there's those kind of thresholds that once you get below a certain figure, the 7%, or even really, I think the 6%, once you start getting in the 5s, I think you're going to see a lot more people feeling more comfortable getting rid of those, 2 to 3 rates a little bit. It's not as much of a sticker shock.
If we see 5, we're going to be in a feeding frenzy, I think.
Mm-hmm. Yep.
Things will disappear quickly in inventory change. And we'll see things change very, very quickly. But I think there's something good in that, being, I think we kind of were all here seeing what we saw in 2006 to 2011, it was brutal. And seeing people making these like financial decisions to say, hey, I'm going to really look at this logically. And you know what, maybe living in the home, it's tight, not having maybe the upgrades that I want, but this rate really makes sense financially. And people are really making the right decision with that. And I think that's probably going to be one more reason why that pent up demand is going to take off that much quicker, because these people, there's only going to be a point where they're finally going to say, okay, we've saved enough money. We've done this long enough. It's time to do it. And they're all going to do it at the same time. So
Yeah, exactly. And then we're going to lose all our inventory again. And then, prices are going to shoot up more. It's just kind of the game. But speaking
Yeah.
of inventory, it's been nice over the last couple of months, however long it's been that inventory has been a bit increased. It's been kind of nice for buyers out there to have some more choices. So I definitely think that that's a plus. But to your point, there are still some certain areas of town out there where they're really hot and they're still in, a seller's market. And if you've got something
yeah.
nice that's properly priced that hits the market, it's getting a lot of action.
Yeah, I
Sorry.
think I was reading some national numbers there. I think the inventory level, I think it's up to about 600,000 nationally, which is 37% year over year. So we are seeing a spike. I know it depends on where you're at. It's definitely regional, but nationally, 37% is where we're at right now. So that's good for buyers because we are seeing, less competition just with more inventory and more price cuts. And for me personally, I know we spoke about it before the show. We are starting to see buyers get a lot more seller pay closing costs with a little bit of an increase in inventory. And seasonally it does, like I said, slow down around this time. So more inventory. I think it's definitely putting some more power in the buyers right now, being able to negotiate and get some better deals out there is what we're seeing. So it's good for buyers right now.
Absolutely. I mean, I just got off the phone with a buyer's agent that showed one of our listings. We've got a listing that's in a hot seller's market right now, and it's an entry level home. And so it's been getting a lot of activity. And he called me very excited. He showed it this morning and he said, "Hey, how many offers do you have? This thing's beautiful at this price. I think it's going to fly off the shelf. Can we give you 10 grand more and then ask for 10 grand in concessions?" Sure.
Nice.
So that's kind of interesting. Say again.
It's an interesting tactic.
Yeah. And hopefully it ends up working out for him.
Yeah.
But it's been a bit of a hot one. And
but it's funny because surprise, just seeing how much it's expanded over the last 20 years. When they were originally building out there, it was a joke. Surprise, it's so far away. But now when you go out there, like it's established. And there's really, now the new building is even further out. So it makes sense. And we're seeing the same exact thing in the Queen Creek area, which, they're going to separate it between Santan and Queen Creek. And those, borders will kind of blend. But it's really interesting to see what's happening over there because much like a lot of these areas, we're seeing like the waves of there's some inventory, then all of a sudden there's a bunch of people purchasing, and then the inventory drops, and then it shifts. And I've seen that happen on both fronts in the resale and also the rental markets. And I think they're playing off each other. One of the things that I noticed that was really interesting, especially like what we were just talking about, with the the homes that are going to be on the lower side of price points, starter homes. A lot of home builders and such are very much targeted on this in areas on the outer lying portion of the valley all around. And what they've realized that they can do, they're targeting rents and they're as rentals. So they know their inventory and they're saying, hey, instead of putting this on the for sale market, we'll do that, but we'll also offer it for rent. It's very, very interesting just because it's kind of adding this like little bit of an artificial, a quick fix to their situation, but then it's kind of flooding the rental market a little bit. But that's why I think we're seeing these kind of anomalies, because it's really not a true indication of these. This is the amount of investment properties that are available for rentals. So where I'm seeing it is their inventory is disappearing. It's going towards rental. It's now less inventory on the sales side. But once we see these rates low, they're going to say, hey, guess what? We're not renewing this lease. We're going to go in there, clean these things up and get them on the market.
Yeah.
That's going to help out on the inventory side, right? As far as the buyers that are looking to purchase. But what it's going to do is it's giving everyone kind of this fake, especially investors that are looking to say, hey, I want to target this area as potentially picking up a long-term investment rental. Oh, I don't want to go there. It's a little saturated. Well, when these guys all exit, I think it's going to dramatically affect that what's available for rentals over there. So for those investors that are, you know, really thinking about long term right now, I think that's something very, very important to consider. I know a lot are even considering arbitrage, where they're ultimately justifying to lose a few $100s in rent, in cash flow over the next 2 to 3 years, anticipating rates to go down so they can refi, but then make sure they're getting in at that lower principal purchase point versus
Right.
trying to do this based off rate. And those guys that are doing that, I think if you do it right and you do it disciplined, you're really setting yourself up, because you're now going to have a lot less competition when your rate drops and you go to refi, and it's going to be a really, really good investment.
Yeah, and you know, I have to agree with investing over on the west side because again, stats from the Cromford report, they are predicting that the population growth exceeds 30%, like little over 30% over the next, well, 9 years now, because it's between now and 2033, which is so crazy to say.
Yeah.
But yeah, they're projecting that, and you know, even crazier, they are projecting a 37.4% increase in the next 10 years for Pinal County. Pinal County is exploding. I'm having more buyers that are looking at Florence, Casa Grande, and areas like that than ever before. Arizona City, even. I'm
Mhm.
having more and more conversations about those areas. Anything that you guys would like to add about that? Are you seeing the same thing?
Yeah, we definitely are. You know, we're here in Gilbert. We have a lot of people who are like right off the bat, we want to find something in Gilbert. Then obviously, you know, like you showed on that slide, it's a seller's market. It's a very popular area and it's expensive out here. So they start looking more in like Pinell County. They start looking in, you know, Queen Creek, Santan, or even Casa Grande, what you mentioned. And just a reminder about some of those areas like Casa Grande, parts of it does qualify for the USDA home loan, which is a zero down loan. It's called a rural housing and has really low mortgage insurance. It's one of the best programs out there outside of VA. So just
Mhm.
remember, if you are kind of looking in those areas like Arizona City, like you mentioned too, a USDA rural housing 0% down loan is an option. And a lot of clients are taking advantage of that right now, especially because the rates are so competitive. They're in the low sixes, very similar to
Nice.
FHA, but no
That's
down.
awesome.
So just remember that program is available if you're looking in those little more outskirt areas.
Yeah, that's fantastic. Have you had any experience with that with your clients? I know you're working with a bunch of investors right now, Matt. Are they looking at those areas at all, or are they kind of steering clear from that for now?
That far out, yeah, they're not, you know, going that far. The ones that I'm working with are looking more like, you know, once again, Queen Creek, Peoria,
Mhm.
Santan, those areas, East Mesa, because I think once again, you start looking at what the balance is between projected value from a rent stance, from a value stance, from where we can enter in, and what's going to happen when rates go down, and what's going to happen when we see this influx of population.
Mhm.
And I think, you know, when you look at those four corners, it really makes sense. Then if you want to take it one step further, you look at where we're kind of advancing technologically. And, you know, remote work is just becoming so much. Yeah, COVID was a big
It's a
byproduct. I
thing.
think there was a pullback, but now I think
Yeah.
a lot of people are realizing, you know what, this is actually a model that works. And I'm starting to see people that are actually getting more remote time, because they felt that it was more beneficial. Then you also have the, you know what I mean, autonomous cars, you know, when you're not going to have to, you know, drive. I do believe we're on the 5 year point where we're going to see this really, really step up in the next 5 years. And if you're living an hour outside of town, but now you can justify getting work done in that hour commute in or whatnot, where you live is really not that important anymore when it comes to your proximity to work and such, because
Yeah.
you're able to multitask and get a lot more done in that you know what I mean? So that's where I do see these little outer lying areas really have some value, especially if we see an extreme boom in value happen in the epicenters.
Yeah. I'm a little, so call me old school, but I'm a little like kind of skeptical about the whole self-driving car. Every time I see it on the freeway or wherever out in, you know, the jungle, that is the city we live in, it freaks me out because there's nobody behind the wheel. It's so weird.
Haven't gotten used to it either. I really haven't.
It's hard. It's hard. And these kids these days are like that's all it's ever gonna be, you know?
Well, that's
Someday
it.
maybe a driver's license is a thing of the past. It's like, you know, ancient times kind of thing, like what my 10-year-old tells me. that I grew up in, ancient times. He calls the 90s ancient times.
Oh my gosh.
Yeah.
Boy,
It's
do I
really
feel old
wonderful.
now.
How were the pyramids built, Mom?
Yeah, he thinks I know, from experience. But anyway, guys, I think that was a lot of, sorry, my voice is just, it's leaving me here. I think that was a lot of information packed in, 20 minutes or however long it's been that we've been on. So thank you for your contributions with that. Is there anything else that you'd like to add or that you think is important for our people to know out there in the month of June 2024 in the Phoenix area?
I think, and I know I've beaten this drum before, but I do think that this summer, it's usually traditionally a slower time.
Right.
And if you're really seriously considering purchasing and I would really make sure your ducks are in a row and you're prepared. Not to say that things are going to turn around and take about face quickly and see inventory dry up, but we are put in that position that it's more likely to, especially when we see rates drop. There's just not as much competition. So if you're, that buyer that is a little bit more particular about what you want in a home versus what you want to spend on that home, I would really, really start, doing your spreadsheet and doing whatever you need to do to prepare your mindset to get serious. Because even if you're not so much saying, hey, I'm ready to go buy a home now, but if you're out looking and you've got everything, ready to go, you're pre-approved, and you're going to be that much more prepared than everyone else that's like, oh God, we got to hurry up and catch on to this.
That's huge.
I
think that's a giant mistake that buyers make. And Ryan, please jump in here. Is they put the cart before the horse and they don't go out and get their pre-qualification. And maybe they don't understand why they need that, which is why they need us to help guide them, right? But that is the first thing you do. Like, that is step one. That is the most important thing as far as I'm concerned. So thank you
and
for
not just
sharing
knowing
that.
what you qualify for. It's good to know the max purchase price that you could get approved for, and that's what we could show you. But really, we want to know what your budget is. Like, what's the max that you don't want to go over in terms of your payment, and what does that house look like? Because we've heard people who call us and say, "Oh, we found this house, $600,000. We love it. We want to make an offer." I'm like, "Oh, this is your payment." Like, "Oh, that's twice as much as we wanted to pay." Because you look online and sometimes the calculators only show you the principal and interest, but you got to factor in mortgage insurance, taxes, and insurance, even an HOA. So there's a lot of things to consider. So yeah, you want to know the most you could qualify for, but you also want to know what price range you need to be for your budget.
Totally agree. And another thing that I tell our buyers constantly when we're having this conversation is getting with, Ryan or somebody amazing like Ryan. There's not too many of them, so Ryan's your guy. But getting with somebody amazing like Ryan is really beneficial, because then you can, if you have any obstacles, say in your credit or with your financials or anything like that, you can get that out of the way beforehand, so that you're not scrambling or unable to get pre-qualified when you do fall in love with that house, or you are ready to move, or you got to be out of your rental in 30 days, right? So it's really important, I feel like, to talk with you several months before I'm even thinking about moving, just because of those reasons. And I've had people give me a little pushback on that. Well, I know my credit's great. It's perfect. Well, you know what? I've pulled my credit before and somebody else's stuff has been on my credit. That can happen, right, Ryan?
It could happen.
Absolutely.
And credit's just one piece of the pie, obviously.
Right.
Even if you have good credit, we don't know in terms of income how much we could use. Some people start getting bonuses and it's very recent, but we need more of a history of you getting bonuses, or your overtime has increased and you could qualify for, or you think you could qualify for more, but we have to take a little bit more of an average. So there's a lot of things to consider. It's not just credit, it's income, assets, and you just want to know and be prepared before you start heading out and even start looking, really. Absolutely.
Yeah, I think it's a good idea. Personally, I'm a preparer, so I want to know. I want to build it, right. I want to build that expectation for myself so that I'm not surprised in a negative way, or downright disappointed when I get to the table. Like, I want to know, and I want to have an opportunity to overcome those obstacles if need be, and time is your friend in that case.
Absolutely.
No, it very much is. And I kind of like the last thing to say on that is what I've realized is when you're in a slightly of a, in a buyer's market, when you're trying to get a little bit better of a deal too, and that you might be contingent, when you actually say, hey, I want to move, what does it really look like? And I've had a few people that reached out and said, hey, I'm looking at this home, and then I'm like, well, how do you plan on, what's your plan? And they didn't have a plan. And I'm
Right.
like, well, you're going to have to sell your home to do this, and this is what it would look like. And if you start trying to buy contingent in the areas that you're looking at, your buying power is shot.
Oh yeah.
Yeah.
You're not going to get the same deal, and you're also kind of held over a barrel because you're only able to choose what you can choose from, who's going to accept the contingency. And now what happens if you now go to sell your home and something happens? You could be stuck in a weird position. So
Right.
that's where it's ultimately good to talk to a lender, talk to your realtor, try to get all of your options into this, and then try to determine what it looks like. What's the best, solution or options for your family, and what's plan B? Because it's very, very important to have that, because it's not going to be as simple as you think.
I absolutely agree. Thank you for saying that. I feel like even if we've done it before, but it was many moons ago or whatever, sometimes, when we're looking bird's eye view or outside looking in, whatever term you want to use, we don't see all of the little details. We don't think all of the little nuances that might be involved. And we think it's a lot easier and quicker than it actually is. So really, really important. And especially in our industry, how often do things change, guys?
Too often.
Oh yeah.
Like,
Always got to
right,
keep up.
you bought a house 10 years ago and you haven't been in the market since. I'm
Yeah.
sorry, sweetie, but it's a little bit different than it was 10 years ago,
100%. Yeah.
So, all right,
Good
guys.
stuff.
Well, thank you so much again for being with us. My voice is gone, so I gotta go.
You
Thanks
should
for
put like
telling me
a
that,
bar
Katie.
background,
Yeah,
like you're
it's
sitting
gonna
in
be
a
really
smoky
annoying to
bar.
listen to. I do, I know. Terrible. It's like I've been singing all night or something. I swear it was just a cold. But anyway, hop on over to our YouTube channel. It is at Team Evo AZ. The very first, in fact, YouTube has a podcast now. I don't know if you guys know that, but our Arizona Monthly Market Update is now a podcast on YouTube. So you can check that out there. Or if you like to watch it on the playlist, we are on the homepage. Just scroll down. It is the first one. You will see our faces right there, and you can backtrack and see what we said 6 months ago, see what we said 12 months ago. I always like doing that. I think it's kind of fun. I do. Or if you are more of the podcast type, you prefer to listen versus watch, on your favorite podcast platform, do a search for Arizona Real Estate Radio, and there you will find us. We will be back next month. See you guys then.
See you then.
Bye, everyone. Thanks.
Bye, everyone.